Hello, my name is Adalessossi. I'm a PhD researcher in finance, and also I am a consultant. Today we are going to present the third step of investment management. To resume quickly what we have presented in our previous videos, we say that investment process management is divided in 5 steps. The first step is to set an investment objective. The second is to establish an investment policy. The third is to select an investment strategy. The fourth is to select specific assets. And the fifth is to measure and evaluate the investment performance. So in our previous video, we have presented the first 2 steps. The third step, which to select an investment strategy, must be consistent with investment objective and investment policy guidelines of client or institution. A portfolio strategy management is divided or can be divided in 2 classes. The first class is active portfolio strategy management, and the second is passive portfolio strategy management. For the first one, you know that active portfolio strategy management use available information and forecasting techniques to seek a better performance than a portfolio that is diversified broadly. There is some particular things about active portfolio strategy management. Essential with all or to all active portfolio strategies are expectations about factors that have been found to influence the performance of an asset class. For example, with active common stock strategies, this can involve forecast of a future earning, future dividends, and future price earning ratios. With active bond portfolio strategy, it can involve forecast of future interest rates and sector spreads. For concerning active foreign security strategy management, this can involve forecast of local interest rates and exchange rates. Concerning passive portfolio strategy management, it focus on minimal expectation inputs and instead it relies on diversification that match performance of some market index. I mean that a passive portfolio investment strategy assume that marketplace will reflect all information, all available information in the price paid for securities. So what I mean here is that for a passive portfolio management strategy, they don't struck themselves to focus or use forecasting investment, forecasting technique to beat the market or to have a high return than what the market will procure. So they are content of what they say, that all the information has been found in the price, so they don't bother themselves. That is, there is some thing that we want to link here also. In some portfolio strategies, several strategies, both active strategy and passive strategy are used together. So, for example, in bond area, in structure portfolio strategies, both active and passive strategy are used. How do we call a structure portfolio strategy? They are the strategy that has based performance on predetermined liability that must be paid out. So between active strategy and the passive strategy, which one an investor have to choose? The answer for this question will be found in 4 factors. The first factor, this depends on the client's or the money manager's views of how price efficiency market is. And also this is based on the client's risk tolerance. And finally, this based also on the nature of the client's liability. When we talk about marketplace price efficiency, this means that how the investor will be strong to earn return, higher return than if he use a passive strategies. He use passive strategy after adjusting a risk associated with a strategy and transaction costs associated with transaction costs associated when implementing that strategy. So in efficiency, market efficiency theory, it said that no one cannot beat the markets. So an investor cannot have a return beyond the expectation or beyond what the market will procure to investor. So in my next video, I present properly what we call efficiency theory, market efficiency theory. Thank you very much.